The game has officially changed. If you thought the volatility we saw this week was just another market correction, you are missing the biggest geopolitical shift in the history of precious metals. We are currently less than 48 hours away from a structural fracture that will decouple the silver market forever. While the mainstream media is focused on the flash crash in New York, they are completely ignoring the iron curtain falling over the global silver supply in the East. My name is Kevin Huang, and this is Markets in Context. Today is December 30th, 2025. And we are witnessing the final moments of the silver market as we know it. We are entering a period of extreme information warfare, and you need to be positioned before the New Year's Day deadline. We have to start with the emergency signal coming out of Beijing. As of today, December 30th, the Chinese government has finalized the implementation of a new export licensing regime for all refined and semi-finished silver. This is not just a regulatory update. It is a resource lockdown. Starting January 1st, 2026, which is less than 2 days away, only a handful of state-vetted companies with massive production capacities will be allowed to move silver out of China. Why does this matter to you in the West? Because China is no longer just a participant in the market. They have become the global price maker. By limiting exports, Beijing is effectively creating a silver vacuum. They are ensuring that every ounce of silver refined within their borders stays there to feed their own high-tech industrial machine. This is a strategic hoarding event that is going to create a catastrophic supply shock for Western refineries that have grown dependent on Chinese supply. We are looking at a scenario where the physical metal simply stops flowing across the Pacific, and the impact on your portfolio could be legendary. Now, let us talk about the flash crash that happened right here in the West on Monday, December 29th. The price of paper silver on the COMEX was slammed from nearly $83 down to a terrifying minimum of $70.25 in a matter of hours. Many retail investors panicked. They thought the bull run was over. But if you look at the data from the report I am holding, you will see this was not a market sell-off. It was a coordinated regulatory hammer. The CME Group issued Notice 25-393, which was the ultimate kill switch for the silver rally. They did not just raise margins, they hiked the initial margin for a standard silver contract by 14%, moving it from $22,000 to $25,000 practically overnight. This was the second hike in just 2 weeks. Think about the mechanics here. First, we have the margin call. Every trader holding a long position with high leverage was suddenly undercapitalized. Then, the forced liquidation. If you did not have an extra $3,000 per contract sitting in your account immediately, the brokers did not ask questions. They hit the sell button for you. Finally, the stop-loss hunting. This forced selling triggered a waterfall effect, smashing through the $80 and $75 support levels until it hit the $70 psychological floor. This was a paper squeeze in reverse, designed to shake out the weak hands before the real physical shortage hits in January. But here is the smoking gun. While the paper price was crashing to $70 in New York, the physical price in China refused to follow. This is where the narrative of manipulation becomes a mathematical certainty. As of 5:01 Hemisphere Eastern Time today, December 30th, 2025, we are seeing a price divergence that should not exist in a free market. While the COMEX is struggling to stay above $75.38 after its dead cat bounce, the Shanghai Gold Exchange is trading at a massive structural premium. Let us look at the exact numbers. The benchmark Edge DA plus D contract closed today at 18,797 renminbi per kilogram. When you convert that, using today's exchange rate of approximately 7.015, you get a physical silver price of approximately $83.35 per ounce. That is a $7.97 per ounce gap between New York and Shanghai. In a normal market, this is a massive arbitrage opportunity. Traders would buy in London at $75 and sell in Shanghai at $83 to pocket an easy $8 profit per ounce. But the arbitrage is broken. It is broken because there is no physical silver available to move. The Chinese are willing to pay a 10% premium right now because they are facing an acute material scarcity. They know the export ban is coming on January 1st, and they are frantically outbidding the West to secure every available ounce. This $8 premium is the lighthouse showing us where the global price is actually headed. The force of gravity is pulling the global price toward $83, not back down to $70. If you want to know how close we are to a total market stock out, you have to look at the SHFE warehouse data. This is the canary in the coal mine. In January 2021, the Shanghai Futures Exchange had over 3,091 tons of silver in its vaults. As of the latest audit on December 26, 2025, that number has plummeted to just 819 tons. We are seeing a vertical collapse in inventory. In just the last week, another massive chunk vanished from the official warehouses. China is the world's largest consumer of industrial silver, and they are now operating on minimum reserves. They are not just buying for fun. They are buying because their entire industrial base is at risk of a production halt. When you combine an 819-ton inventory, the lowest in years, with a total export ban starting in 48 hours, you have the recipe for a squeeze that will make the 2021 silver movement look like a rounding error. To make matters even more dire, the Chinese markets have entered a state of extreme stress known as backwardation. For those who do not follow the technicals, backwardation happens when the spot price for immediate delivery is higher than the futures price. Usually silver is in contango, meaning it is more expensive to buy in the future because of storage costs. But right now in Shanghai, the spot price is hitting peaks of 19,400 renminbi per kilogram, while the future contracts are lagging significantly behind. This tells us one thing. The market has zero trust in the future delivery of metal. Large industrial players in the East want the silver in their hands today, and they are willing to pay any price to get it. This is not speculation. This is a physical panic. And while the West is distracted by margin calls and paper liquidations, the actual metal is being vacuumed off the surface of the earth by the Chinese industrial machine. The fundamentals are driving this train, and the tracks lead directly to a triple-digit silver price. For the 5th year in a row, the silver market is in a structural deficit. This is not just about coins and bars for investors. This is about the survival of the green energy transition. The photovoltaic industry, the solar sector, is currently the single largest consumer of silver. In 2025, we saw record installations in China, and those installations are not using the old technology. The industry is shifting to N-type cells like TOPCon and HJT. These new cells are more efficient, but they require between 20% and 50% more silver per watt than the old P-type technology. Even as manufacturers try to reduce silver usage, the massive increase in production volume is overwhelming any savings. This is a silver black hole. The demand is inelastic, meaning these companies will pay $100 or even $150 per ounce, because the cost of silver is still a small fraction of the total panel cost. But without it, the panel cannot be made. Think about the sheer scale of the situation. We have Western banks trying to suppress the price through paper contracts and margin hikes, while the physical demand for the most important industrial metal of the decade is exploding. We have a massive $8 premium in Shanghai that shows the West is literally running out of metal. And we have a superpower, China, closing its borders to silver exports in less than 48 hours to protect its own industries. The setup for January 2026 is unlike anything we have ever seen in the commodities market. You need to be aware that the $70 base we just saw is not a sign of weakness. It is the new floor. The real money, the institutions, the family offices, and the industrial giants use that flash crash to absorb every ounce of supply dumped by the speculative traders. The support at $70 held perfectly because the physical demand is too strong to let it go any lower. Beyond the solar sector, we are witnessing the birth of a second industrial black hole, the electrification of transport, and the explosion of artificial intelligence. A standard internal combustion engine uses a relatively small amount of silver, but a modern electric vehicle is a different animal altogether. According to the latest industry data, battery electric vehicles consume between 67% and 79% more silver than traditional cars, with each unit requiring up to 50 grams of the metal for battery management systems, power electronics, and high-speed charging infrastructure. With EV penetration accelerating globally, the automotive sector is on track to become a primary driver of demand by 2027. Then there's the AI revolution. The massive expansion of data centers required to power large language models is creating an unprecedented need for high-performance computing hardware. These systems require connectors with ultra-low resistance and high reliability, applications where silver has no economic substitute. Global IT power capacity has surged from less than 1 gigawatt in 2000 to nearly 50 gigawatts in 2025. Every new server, every network switch, and every high-frequency connector is effectively a tiny vault locking away silver that will likely never be recycled. This brings us to the banking war of 2026. The disparity between institutional forecasts is staggering, reflecting a total lack of consensus on where the ceiling actually is. On one side, you have Goldman Sachs, which has labeled silver the strategic metal of the green transition, projecting an average price between $85 and $100 per ounce. Citigroup is even more aggressive, raising its outlook to $110 per ounce for the second half of 2026, citing an acute scarcity of physical metal for immediate delivery. On the other side of the aisle, you have JP Morgan and Commerzbank. JP Morgan is maintaining a much more moderate target of $56 to $58, betting that a global economic slowdown will eventually temper industrial demand. Commerzbank is the extreme outlier, labeling the current rally a speculative bubble and forecasting a crash back to $43. But here is what the big banks are missing. The retail consensus is now almost entirely decoupled from institutional models. Recent surveys indicate that 57% of private investors expect silver to trade in the triple digits, above $100 within the next 12 months. This euphoric sentiment is a powerful force, especially when combined with the structural deficit we just discussed. When retail buyers refuse to sell their physical holdings and instead buy the dip at $70, they effectively remove the buffer that banks rely on to settle paper contracts. Of course, we must address the black swan risks that could derail this $100 trajectory. The most significant threat is technological substitution. As silver prices stabilize above $70 or $80, the incentive for manufacturers to switch to galvanic copper becomes immense. While copper is less conductive and more prone to oxidation, advanced technologies are making this shift a real possibility for solar panel producers. If a major player like Samsung or a top-tier solar firm announces a silver-free breakthrough in 2026, we could see a structural collapse in the price. There's also the risk of a hawkish Federal Reserve. If U.S. inflation remains sticky and the Fed is forced to pause rate cuts or even raise them, the resulting dollar strength would create a massive headwind for all commodities. Finally, geopolitics remains the ultimate wildcard. While tensions in areas like the Taiwan Strait often drive safe haven demand, a direct conflict could also shatter the global electronic supply chain, causing a sudden drop in the industrial demand that silver so desperately needs. However, the operational conclusion for today, December 30th, is clear. The market has successfully absorbed the margin call shock from the CME. The fact that silver bounced back above $75 immediately after touching $70 proves that the underlying trend is firmly intact. The Shanghai Premium remains the most reliable indicator of truth in this market. As long as China is paying $8 more than New York for physical metal, the global price is being pulled upward by the reality of scarcity. We are heading into 2026 with the lowest warehouse inventories in a generation and a superpower that is about to lock its export gates. If those 819 tons in Shanghai continue to dwindle in the first weeks of January, a squeeze toward $100 is not just a possibility. It becomes a mathematical probability. The window to position yourself before the New Year's Day export ban is closing. This is a market where physical metal is king and paper promises are becoming increasingly worthless. My name is Kevin Huang, and this is Markets in Context, and I will see you in the next video.